Welcome to Thoughts on the Market. I am Vishy Tirupattur, Morgan Stanley's Chief Fixed Income Strategist. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the impact of potential regulatory changes on bank assets. It's Tuesday, April 18th at 11 a.m. in New York. In the wake of the tumult in the banking sector since early March and a significant intervention by the authorities, it is likely that a regulatory response will follow, particularly focused on the regulation of regional banks. President Biden has already called on the federal banking agencies, in consultation with the Treasury Department, to consider a set of reforms that will reduce the risk of future banking crises. A review led by Michael Barr, the Vice Chair for Supervision at the Federal Reserve Board, is set to be released by May 1st and will likely offer some indication as to where future bank regulation might be headed. In this context, it is worthwhile to examine potential changes to regional bank regulation, reflect on how banks would respond to such changes, and consider their impact on markets. Across all banks, there are approximately 4.7 trillion of non-interest-bearing deposits with a duration of about 7 years. Banks will likely need to either review and re-justify or shorten such deposits. Our bank equity analysts expect two key regulatory changes: TLAC, total loss absorbing capacity, and LCR, liquidity coverage ratio, to be extended to smaller banks above 100 billion in assets, though this process will likely not get fully implemented until 2027. From the perspective of rates markets, these changes make the case for steepening of the curve. Our rate strategists see bank demand for treasuries increasing relative to other assets with greater LCR requirements. Both shortening deposit duration and implementing LCR suggest that banks would favor shorter dated treasuries over longer dated treasuries. More longer-term issuance due to TLAC drives higher long-term yields in fixed income, which supports curve steepeners for treasuries over the medium term. For agency mortgage-backed securities, these changes will result in less demand from banks and consequently wider mortgage spreads. For munis, these changes would likely imply a lower footprint from banks, with available-for-sale securities favored over held-to-maturity securities. For securitized credit markets, we see downside in demand ahead. Longer-term outlook for securitized credit depends on the specifics of regulatory reform, but is likely to remain tepid for some time to come. The expansion of TLAC to smaller banks could intensify supply headwinds in the medium term. Our credit strategists believe that supply risks in bank credit are now skewed to the upside. The emphasis on funding diversity and shift away from deposits to wholesale funding is likely to keep regional bank issuance elevated for longer. An important lesson from recent events in the banking sector is that the risks to the assets banks hold extend beyond credit risk into other risks, most notably interest rate risk. While interest rate and convexity risks are reflected in Comprehensive Capital Analysis and Review (CCAR) and Horizontal Liquidity Review (HLR) tests, arguably not having an interest rate component to risk weights enabled banks, and regional banks in particular, to seek term premia to support their earnings. It is not our base case that this would change. However, it is possible that regulators would at least consider enacting some type of a charge for owning longer duration securities. At a minimum, we expect regulators could require all banks to flow mark-to-market hits from available-for-sale securities through their regulatory capital ratios, something that the big banks have been doing already. Ultimately, new regulations for regional banks will take time for formulation and implementation. We'll be watching developments in this space closely. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share Thoughts on the Market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.